Hi, Matt Battye here with our budget update. Obviously, this is an interim budget for the new Labor government, and there was a lot of speculation leading into this budget about exactly how Labor would approach it, given not just the state of things, the economy and inflation, but also being their first budget of the new government. So I guess the short version is this wasn't as comprehensive as some might have feared, and the ultimate question, I suppose, is most people ask is, well, this is a good or bad budget? And that really, I guess, ultimately comes down to where do you fit on is the government better at spending our money than we are sort of side of the curve. But I guess in a really simple sense, this budget didn't seem to go that far in terms of lots of new spending and lots of new initiatives. There was a lot of sort of rehashes of existing policies, particularly in relation to tax and superannuation. Possibly the good news for many is that there was a bit of a hint leading into this budget that the stage 3 tax cuts, which are due to come in from 1 July 2024, already legislated and in place, might have been under threat, but essentially the government have said that they're not going to change those at this point in time. So we'll dive into, there's a lot of detail in this budget, but there's really only a couple of major highlights we want to sort of flick through. So let's start with superannuation. Then it was really mostly about reconfirming some of the things that were already put in place in previous governments. Probably one of the main ones that might be of use to people, particularly in around retirement, is the reduction in the downsizer contribution. So this is the money that you're able to put into super outside of the other contribution caps from downsizing a house. So that was already reduced from 65 down to 60, but they're going to drop it down to age 55. So for those people selling houses post 55 and post once this receives royal assent, then there'll be the eligibility to contribute up to $300,000 each. Obviously, this is in addition to the non-concessional or concessional contributions people can make. As far as tax goes, there was a lot of sort of anti-avoidance rhetoric around getting after companies or individuals that sort of, let's say, gaming the tax system to some degree. So, but the main thing for most people is really there's not changing of the stage 3 tax cuts. One of the interesting incentives, though, that was announced was more incentives towards purchase of electric vehicles. So not just discounts to electric vehicles, but also making them FBT exempt, which may be of use for people who are looking to upgrade and were looking to buy electric vehicles anyway. The fact that they'd be FBT exempt will certainly add to the attractiveness for things like salary paging. So that was certainly something that that people might be interested in. Stage 3 tax cuts, as I said, they're not going to change. So at this stage anyway, the government seems to have backed away from making any amendments there. Moving on to Social Security, there's quite a lot of detail in the Social Security aged care sort of space. So particularly of note for many people will be the lifting of the income threshold for the Commonwealth Seniors Health Card. So that eligibility has changed a lot in recent years with thresholds sort of changing. So I know many of you have already been through that process with us, and particularly with Marcus going through a lot of those applications. But anyone who hasn't been eligible in the past, that's going to open up to a lot more people, because the threshold's moving from sort of 61,000 up to 90 for singles, and from 98,000 up to 144 combined for couples. So that will open up for a lot of people who are just sort of potentially missing out. Now that was initially proposed to come in from September, but it's now will be 7 days after that legislation receives royal assent. So we need to stand by in terms of that, but there will be a range of people now eligible that weren't before. So there were some changes to work bonus and some of those other sort of Centrelink payments. I won't go into a lot of detail with that. Childcare, though, was and maternity/paternity leave. There was some pretty big extensions there. So with paid parental leave, sort of moving out now to be a full sort of 20 weeks. So that eligibility has changed a lot. Again, probably not a huge issue for many of our clients, but maybe for some of your children, as you know, some of them are taking time out of their workforce as well. So there's been quite a bit of changes to that. So those who are, you know, in that sort of stage of life, it's certainly worth looking at understanding what your entitlements are from a paid parental leave perspective. Again, as I said, there's not a lot of major things in this budget, so we don't spend a lot of time, a lot of detail going into the nitty-gritty. We're happy to do that specifically as needed for clients. Probably the main ones are those Commonwealth senior healthcare changes as they come into play, and the downsizer contribution. So, you know, anyone who's potentially looking at, you know, changing houses in the foreseeable future, particularly those who are sort of under age 60, that eligibility sort of open up to allow more money to go into super outside of the other threshold. Other bits and pieces will be very much contextually dependent. So by all means, have a look through. We'll send through with this video. There'll be attachment with a bit more of a summary. You can go through that detail, but we'll be dealing with any of the nuanced individual ones, you know, as part of normal reviews. But as always, if you've got any questions, feel free to reach out. If there's anything you saw in the budget that you want us to go into a little bit more detail on, certainly happy to do that. Probably the one thing that has been a little bit missed, I think, from most of the commentary is a change to the share buyback or off-market buyback scenario. So you may see a little bit about this. You would have seen historically, particularly a lot of the banks and large companies in Australia doing off-market buybacks of their shares. And the reason they did those is because they were able to pay a lot of those proceeds via way of a franked dividend, which became a very attractive, or essentially particularly for super funds and or in super funds in pension phase, was quite an attractive proposition. The government's essentially taken that effective loophole away, and the difference between an on-market share buyback, where essentially all the proceeds are a capital payment, there's no dividend and therefore no franking credit, versus an off-market where you could actually get that franking credit. So that's changed. So that arbitrage opportunity, which some super funds in particular had taken advantage of historically, that will disappear. Now, what will that mean in terms of returns? Certain types of strategies will be slightly affected by that, but that's probably not a huge contributor to return. You know, it has been in a couple of years when we've had really high dividend payments and as a result of share buyback things. But, you know, if you look at that on the impact of that over returns in the long term, it's relatively small, even in funds that use that strategy when available. So obviously we'll be looking at that in terms of the impact of that with any funds that we use, any investment strategies we use, but the impact of that we're not expecting to be enormous, because those who've participated in those in the past would know also they often got sort of reasonably scaled back as well. So on aggregate, there's a bit of money for government to be saved on that, but it hasn't had that big, and we don't expect to have that big of an impact in terms of individual portfolios. But that is one of the measures that kind of got sort of slipped under a little bit, and we haven't seen so much in a lot of the rhetoric, but that regime's over. So yeah, if you've got any questions, by all means let us know. As I said, you know, this is there's a lot less in this budget than some may have feared. From an inflationary sort of economic perspective, any budget that spends more money is always going to be slightly inflationary, but there's, as I said, not a lot of new stuff in this budget. So we'll see how that plays out in the next budget next year. But for the time being, there's not a lot to do in the short term, but we will be monitoring in the reviews. Thanks again, and we'll talk to you again soon.